Welcome to the show. We are in the new studio. We have been working hard placing 1 million sound panels, getting ready for shows like this with the wonderful Cory. So guys, if you have questions, do me a favor, just post them in the comments and we'll get to those kind of as they're appropriate. But guys, I am honored to welcome Cory from Traders Landing to the show. Cory is both a professional trader as well as runs a community that is for traders. They do trading, they do some PAMM accounts, and they're making big waves in this space. So Cory, I'm excited to have you on, man. How are you today?
Excellent. How are you?
Doing good, man. We just finished up. We just had a 4-day event here at the building, so I'm a little bit wiped out, but we're doing good.
Yeah, I saw in your community it looked rather exciting and very informative.
Absolutely, man. So Cory, I know a little bit of your story, but maybe a lot of people don't. What were you doing before trading, before PAMM accounts, before all of the kind of the insanity?
Yeah, I'll give you a quick synopsis of my foray into trading. It started out, I owned a deregulated energy business in New York, and my first exposure to trading was hedging contracts on the NYMEX. So we would purchase natural gas and serve it through the utility. In New York, it's Con Edison and National Grid. And then you would get a fixed rate for someone, and then you would have to go on the NYMEX, and we had professional traders do that, which I became friendly with. I used that knowledge in 2017 to run up to 20,000 on Bitcoin. I got into crypto trading. I found a YouTuber called Quick Fingers Loop, and he had a trading system that worked 95% of the time, not 90, not 80, it worked 95% of the time during that run up to 20,000. And it was very simple. He didn't ask for any money. In fact, people created a community around him. His fans created a Discord, they created a Slack. It was super active, and I thought it was the easiest thing in the world. I was going to be a trader. So I thought this energy thing is a waste of my time. I could make all this money trading. Then what happened is that market inefficiency went away after the top at 20,000. And then I had to learn to really trade, at which point I took a course with a company called Elliott Wave Forecast, and I became an Elliott Wave trader. And then I had to stop trading crypto because the altcoins, I couldn't get into size. The money I needed to make wasn't there. So there would be opportunities on small coins being traded. And the problem was the size that I was going with, I would be the whale on these small coins, and I would just envelop the order book. So I couldn't get in and out of positions, no matter how many ladders I set, at which point I switched over to Forex, which is a lot harder to read the chart. There's a lot more institutions in there, institutional investors and actors. At that point, I developed a new strategy. I got to a trading group. I developed traders together. Thank you. And I learned a new system from a fella named from a fella from Russia. I never met him. And he developed this one trading setup, which I'd use to this day. It's called Fibonacci channel projections. And that's how I trade. So during the day, looking at charts, I look at primarily 15-minute to 4-hour charts. You're sitting there and you're doing nothing all day. And one of the things I like to do while I'm in front of charts is testing trading systems. So I created this YouTube channel where I create testing trading systems. And all of these people wanted to go and they wanted to learn how to trade. So I created a community out of that. And we had a paid membership, and I would have custom indicators and testing scripts and all of these things. And one of the things that I learned is that nobody wants to put in the time to learn how to trade, or very, very few people. So I would have people in the group and I would try to get them test this, test this. Nobody wants to sit, or not many people want to sit in front of a chart and test one trading setup thousands and thousands of times over multiple different instruments. It's just not something people want to do. So it was kind of spinning my wheels. I was getting members, but I wasn't really accomplishing what I set out to do. And then the world of DeFi came in, and there was a lot of opportunity in decentralized finance. And I think that means a lot of different things to a lot of different people, but a lot of people associate it with passive income. So I took my knowledge of trading systems and trading bots and different things and my connections with different traders, and I tried to recruit them to start PAMM accounts or to get into passive trading opportunities or look at bots. I started to cover these on the YouTube channel and develop the community that way. And it seems to be a lot more responsive because people could be profitable right away. But there is, and depending on how you look at it, it can be more risky or it might not be. If you're not willing to put in the work to learn to be a trader and to learn to make the trade yourself, then it's not as risky as someone that just gets on the chart and thinks that, oh, it's an uptrend, I'm just going to buy here and I'll hope it works out. That's definitely more risky. So that's where I'm at right now in terms of my journey through as being, I guess, an influencer, a YouTuber, and a trader.
At what point did you, I guess, make that decision from what you were doing in the energy world to, I mean, do you still do that? Are you full-time now? Like, what does that look like?
Well, I am, not to get too political, but I have more of a libertarian bias that people should just be allowed to do what they like. And what happened was I was in the deregulated energy space in New York. What happened was, believe it or not, the Village Voice, which is a very powerful small newspaper in Manhattan, did an expose on my industry, my energy industry. And there were some very bad actors that were doing some bad things with terms of pricing some low income people. And it was a big story. And the governor of New York at the time, Andrew Cuomo, decided to single-handedly stamp out the industry. So he ordered his Public Service Commission to basically write an order saying that this is not going to be allowed anymore, basically making the rules for business so that it could no longer be profitable. Of course, a governor or any politician can't do that like he did it. You can't do it force, you can't do it in mass, just make a decision overnight. The Constitution stipulates due process. So I knew that this was going to be settled out in the courts over years. And that was my time, I thought, to exit, because there were still people in the industry that thought that there would be a positive outcome to this through the court system. I didn't. So at that point, I got out and I became a trader and I moved to Florida. That's basically why I'm here.
I mean, certainly you have better weather.
Absolutely.
So I trade myself. I'm a little bit, I would consider myself newer to it. I've tried it kind of off and on over the years. I do believe that it's one of those skill sets that if you can dedicate the time, the energy, the mental fortitude, and then really, really regulate yourself, you can do phenomenal. You can do great things, especially if you have the right system, like you mentioned. Mm-hmm. So if that proves to be true, why would people do a PAMM account? Or why would they go into like a DeFi play or a crypto play, somebody they've never met, somebody they don't know, somebody that maybe is newer to the scene? Like, why would they ever do that versus just trade themselves?
Yeah, that's a great question. The hardest part of being a trader is developing a mindset, a trader's mindset, thinking in probabilities. So that's why I tell people, you have to test your system thousands of times. You have to back test it before you even start forward testing it, because you need to have the certainty in your mind that even though I took 5 trades that turned out to be losers in a row, which is going to happen, I know that over a series of many trades that this is the probability rate, because the market's fractal. It just patterns over and over and over again. Most people can't handle that. So what's going to happen is they're going to reverse engineer their trading system. So after 5 or 6 or 7 losers in a row, they're going to say, you know what? I added this indicator to my chart and I only got in at this point, then these losses would not have happened. But guess what? You didn't back test that for thousands of times. You didn't forward test that for 6 months. You have no indication other than those last 5 trades or 6 trades that adding that to your trading system works. And that's when people start to lose money. They don't properly test their trading system, back test. They don't properly forward test their trading system. They're not able to think in probabilities and they don't have the confidence in themselves. That being said, some people are able to do it. Mark Douglas is probably the seminal person in terms of thinking like a trader and the trader's mindset. I strongly suggest anyone reads his books, and we cover it in our community as well. So that versus putting in that work, which I could tell you from experience, not many people want to do, versus DeFi, right? So the way that I look at DeFi and the way that I approach DeFi is from a sports gambling mentality. So I look at it as risk capital. So I have all of this risk capital and I break it down into units, basically how a professional sports bettor makes money. So I break it down into units, and I have, because I don't like to talk about my numbers because my numbers aren't relative to, let's say, Elon Musk's numbers or the guy bagging my groceries. The numbers are completely different. And I think it can get misleading. I'll discuss it more in the community, but certainly not in public. So I discuss it in terms of units. One risk unit to me is I'm taking all my risk capital, I'm breaking it down into units. And one risk unit is something that I don't care if I lose it. If I lose it, if I take that money and I spend it on dinner, I spend it on something for the kids, or I spend it on nothing, I don't care whether I have this money or I don't. So I'll get into a bunch of crazy DeFi projects based on one risk unit. And then after time, there are certain things where I will increase my risk exposure to 2 units, 3 units, 4 units, maybe even 5 units. And it's all dependent on how I mitigate my risk, basically how I analyze a particular project or a particular opportunity versus how diversified I am, how spread out I am, and where I have those buckets of funds, those buckets of units. So ideally what you want to do is you want to take this small risk capital and turn it into bigger risk capital. And how you do that is you generate profits from that first risk units that you put into one project, or maybe 2 or maybe 3. And as the yield comes up, you don't reinvest it in, you diversify it, you go into other things. And then some are going to crap out, some are going to hit, and you're going to be exposed to all of it. And because some things that hit in DeFi, the gains are crazy. So you could have 6, 7, 8 losers and 2 winners, and you could still make out like a mint. And a lot of people don't understand, and it's really a psychology issue. So they'll see crazy gains on a PAMM account or a copy trader or a coin or whatever, and they want to put all their money into it because they're pigs, right? So it's bears make money, bulls make money, pigs get slaughtered. If you see an opportunity where the growth is explosive, generally speaking, that also means the losses could be explosive. So it's very volatile. So in that instance, I could make a lot of money by putting small money in there. So why am I going to put a lot of money into this huge volatility thing? Because I'm going to be a pig and I'm going to say, I'm just going to cash out my life right now. Chances are you're going to probably lose that money because your mindset is completely wrong. But if you go in with small money and that doubles, triples, or whatever it does, and you start taking money out, it's a more responsible way to play the game. It's a more responsible way, and it keeps you in the game for a longer period of time.
What I'm gathering from what you're saying, and I guess what I truly believe and what I teach in this community is like nothing is forever, especially in crypto and like and not so much like the altcoins and like the A-list, like blue chip coins or like whatever you want to call them. That is has somewhat of longevity. But these random websites that pop up and Manny this and Freddie that, they have all of these claims. Like you might be able to make money in that for a very short period of time. But what it comes down to is emotion. So both with Forex trading or trading crypto or any of these like alt projects, it's going to come down to emotion and being able to regulate yourself. So I was saying this the other day and people were really offended with it. I'm like, you guys are rugging yourself. You're rugging yourself because you do not know how to control your emotion, can't regulate yourself. And Cory, we've had people that have put 100 grand into a project to lose it literally 2 days later. Why would you ever do that? I mean, it's truly mind-boggling.
I was gonna say, if you're going to put 100 grand in a project, your risk capital wallet should probably be around 5 million.
But people don't think like that because I think there's a general lack of education in the space. So I bet you agree with me, but I'll check anyways. I've been telling people for a little while, like the biggest problem in crypto and DeFi is like these guys are not business owners. Not business owners. They've never ran a business before. They've never played with risk capital or percentages or even like having a liquidity fund. Like it's just they heard about it from somebody. They've jumped online and they said, oh my gosh, look at how much money I can make. They have no business plan. They have no business model whatsoever. Would you agree with that?
Take it a step further and be a little more specific, because a lot of people think that they're business people. They could be an administrator at an office, or they could be a lawyer, or they could be a doctor, or they could be, a professional. When you run a business, the most important thing is your responsibility for P&L, okay, your profit and loss. And as a business owner, that's your numbers. That's what you're looking at. And you could either treat DeFi as a business and examine your P&L and understand how that works and how to hedge risk and all of these things that affect the profit and loss. Or you can be a tradesman and you could just get into nonsense and hope it works out. There's definitely two approaches. And DeFi offers the ability to do those two things. And one of the things that's great about DeFi is I could send money all around the world without the permission of a regulator or a bank. Okay. And that is true freedom. And that's what they're trying to take away from us. And remember, I alluded to earlier, I'm a true libertarian and I believe in that. And I don't believe that the government should be encumbering on us. And I think a lot of these bad actors are going to bring a lot of pressure on us, unfortunately. But at the end of the day, as a participant in DeFi, you are making the choice that you're not playing in the government sandbox, that you are making that conscious choice not to have that protection, not to have the nanny watch over you, and you have to be responsible. And if you're going to make it in this game, then you have to understand that you're responsible for your own profit and loss. And there's a way to mitigate the losses and to accentuate the profits. And it starts with your mindset.
There's a reason why people are accredited or not accredited in the real world, not decentralized land. In the real world, there's a reason why they have set up regulations, and there's opportunities, in case anybody doesn't know, there's opportunities that are only available to accredited investors. But what people don't realize is if you're an accredited investor, they have determined that you either make enough money or you are profitable enough to basically put on your big boy pants to make your own decisions. Mm-hmm. The same gains and the same opportunities are now available to 16-year-old kids or anybody with access to internet and a phone and a crypto wallet. Same types of gains and the same opportunities are now available for them with no accreditation, with no regulation, like no vetting at all. So yeah, you can win. There's a kid, he's a couple hours from here. There's a kid over here that literally in high school and he's made millions of dollars. So people hear that and they see that and they're like, oh my gosh, I can do this. So the same thing that we praise and the same thing that we reward can actually teach us bad habits, because I guarantee you that kid, it was probably luck, right? I mean, let's be honest, it was probably luck. You don't make millions of dollars as a 17-year-old typically. It's almost like we're getting rewarded for doing some of the wrong things. That makes sense? It's like if I'm gambling or even if I'm trading like the US 30 and I'm trading wrong, but I'm making money. I'm subconsciously teaching myself that, hey, this is good. This is good. When really the opposite is true. Does that make sense?
100%. And I want to circle back to the point that you made in terms of qualified access to capital. The largest bank in the United States is Chase. You've probably seen, I think you're in Ohio, right, Jordan? You have Chase in Ohio, Chase Bank. So you're going to see Chase Bank and you're going to see on the outside, they have something, there's a little plaque there. It says private client, right? So to be a Chase private client, you have to have a certain amount of equity, either in your business or personal. I think for personal, I think they want you to keep like $500,000, I think it is right now in terms of investments or whatever. If you're a private client, you then get access to all kinds of investment vehicles that the normal customer cannot get access to. And the reason why is because they're more risk, right? So the government's going to say to Chase, and they're going to be like, well, this guy's making 50 a year and you gave him access to this investment vehicle, and the government will come down on them. In theory, this is what they're saying if the person loses money in that. Whereas someone of a higher net worth is assumed to be more sophisticated than that. So they have access to all of these things normal bank customer does not have access to. They're a qualified investor. DeFi DeFi takes that completely away. It says, you know what, you aren't at that stage in life yet, but you want to get there. And maybe you have the discipline, maybe you have the luck. And I think all luck is when opportunity meets preparation. Maybe that happens to you and you're able to go ahead, take advantage of these opportunities. Certainly there's going to be a lot of loss and you have to be able to handle that, but there's a huge volatility, and volatility is how traders make money. So there are those roadblocks from an institutional level that DeFi completely destroys. We have access to everything in DeFi.
I want to circle back to the PAMM accounts that you've been doing, because there's a lot of controversy around PAMM accounts. So for anybody that doesn't know, PAMM account is, what is it? Percentage allocation management module. Is that accurate?
That's right.
Yeah, I mean, so a PAMM account is basically you're pooling funds with other people and someone else is trading or operating that fund. That's the long story short of it. There's a lot of controversy. I've certainly lost a lot of money in PAMM accounts. Seems like they do really, really good for a month, and then they lose, or they have an 80% drawdown or something like that. Then they do it again, and there's this big wave going up, then they just tank. So that's been a little bit of my experience, but I've also seen, Cory, on your channel that there's probably on the flip side, there's ones that have been a little bit more steady and a little bit more, I'd say, maybe consistent. What do you attribute that to, and what should people be looking for if they're considering going down like the PAMM account route?
Well, certainly, I don't know if you want me to give you the backstory on what's going on with PAMMs and why they. Okay, so in the aftermath of the financial crisis of 2008, 2010, they passed Dodd-Frank. That was the big regulatory bills that revamped the entire U.S. Regulatory system, in theory, to prevent these issues from happening. And the one thing that they were supposed to do, they didn't do, which is regulate the credit rating agencies, but that's for another story. One of the things that happened in Dodd-Frank is there was restrictions, heavy restrictions put on U.S. retail traders. So for instance, there was no longer hedging available. So you couldn't do delta neutral strategies. You couldn't take a buy one and a sell one in the same account. There was leverage limitations. You couldn't trade over, I think it's 50 on the major pairs and 20 times on the alt pairs with a U.S. regulated broker. You couldn't do PAMM accounts. You couldn't trade CFD. So I can't, as a U.S. citizen with a U.S. broker, I can't trade XAU USD. I can't trade oil. I can't trade all of these things. I could trade them as ETFs, but I can't trade the actual contracts for difference. So all of these crazy draconian rules. After that bill passed, most of the Forex brokers exited the U.S. market. I think there are 3 or 4 big ones left today. I think about 40 something left. So the reason why, again, is to highlight how risky a PAMM account is. So basically you're in, and to highlight just the PAMM account side, they don't want regular uneducated investors going into these PAMM accounts. So now they are offshore. And if you're in the US, you have to get in with crypto and all of these things because they are dangerous, right? Because generally speaking, most of the time, you don't know who is trading that account, what is going on with that broker. So there was a big one about 6 months ago called FX Master Gold. I don't know if you ever heard of that one. Okay, so basically...
Why are you going to bring that up, Cory?
All right, so basically what happened was the broker and the trader were the same entity. So the scammers got together and they registered a broker with MT4 so that they could be on my FX book. I got into it initially and I was covering it on the channel. And then we figured out at one point that the numbers weren't aligning. Okay, so if gold is at one price, the MyFX book is showing another price, and I emailed support and I got some nonsense answer and it wasn't really satisfactory. So we pulled out a little bit and it became more of like a Ponzi hedge, which I don't get befuddled by middle-class moralities. I mean, if I can make money on something, I'll make money. I don't care, to a certain extent, but in terms of DeFi, I really don't care, as long as they're not, doing something, like vicious with the money or better than just making money. So we kind of covered a little bit and said, it's probably going to go away. Take out your initial while you still can and just ride the profits if you want, if that's what you want to do. And then they gave some crazy story that they got into a martingale trade and went out, and I did a video on that, and I examined the trades because it was a MyFX book and it wasn't a martingale that got them out. It was BS trading numbers. So basically what they do is they'll go in the back and they'll alter what the record says in terms of where price meant, and then the MT4 account will reflect that. So there are those issues. So basically the first thing you look at when you're in a PAMM account is the institutional risk, the institution where you're placing, that takes custody of your crypto or your money. It's their reputation. Most of these PAMM accounts are run by unregulated brokers, because if they did have regulation, then the United States government could just come crashing down on their head and take them out, and nobody wants that. So they kind of stay under the radar, and they're known by traders. So, some of them, big one is like LQDFX. A lot of people like to use them. bigger one recently, like NVFX, or I think they have 2 other brokers that they run. And I'm really big on Lyrinx. So first thing is you want to make sure the person taking custody of your crypto isn't out to steal your crypto. All they want to do is make money on the trade. And then you have to analyze the investment, so the actual PAM or the copy trader. And the first thing that I look at is the minimum requirement. Is the minimum requirement more than you can afford to lose? PAMs that I cover on my channel, most of them are like $100, $250. Typical DeFi investor is not going to have a problem losing $100 or $250. Typically, it's not going to happen. So I like to cover those. And if the minimum is there, then you're looking at the trading performance. So if you see a trading performance and the guy made like 100% last month, well, guess what? Probably not using a stop loss, probably not a responsible trader, but you could still make money with it, right? So if you want to turn 100 into 200, maybe that's what you do. Or maybe you want to take 100, you take out 50, you hedge a little bit, you get another 50 out, and you just let it ride, and you just start taking profits out regularly. And maybe it lasts 2 or 3 months with those 100% gains. Typically, when you see trading results like that, they're fleeting. And like you said, there'll be an 80% drawdown and it'll blow up. A lot of times what I like to look for is PAMs with losses. I want to see how they handle the loss. I want to see what happened in the market when that loss happened. Like for instance, we have the blue bullhead, right? Bullhead took an 11% loss when the core inflation report came out. And now you could look all over YouTube at traders accounts. They all blew up. This guy took an 11% loss. All of these other accounts blew up. Maybe this guy is responsible, right? That's an indication to me. However, we had a problem with our bullhead trader, blue horseshoe PAM account, where the copier was actually couldn't open up the larger position sizes because there was a limit on the lot size with the broker, and the copier wasn't rigged to go ahead and open up more positions to alleviate that situation. And these are all risks that we take in DeFi, right? Because these aren't Fortune 500 companies running your PAM accounts. This is the guys that I deal with and recruit to run PAM accounts, or the people that I talk to and I cover their platforms. They're regular schmoes. They're like us, right? And there's no one over their back watching and saying, oh, did you test that? Did you test that? What are you going to do if this happens in the market and that happens? They aren't thinking about that. All they're doing is trading to the best of their ability. So that's where the inherent risk goes to. Generally, all of them want to make money. But the one thing I will warn you that a lot of people don't consider when entering PAM accounts, and you spoke to the 80% drawdown, is that most PAM managers do not get paid unless there's a profit in the account. So basically what they're going to do is they're going to hold on to that position until it gets profitable, because you know what? If they don't, they're not going to get paid. A lot of times it's selfishness, okay, on their own. And they're like, you know what? I'll just blow up this account because I'm not going to get paid anyway. It's going to take me 3 months to get back into profit where I could start making money again. You know, I'll just blow up the account and start a new one, which will be profitable right away, and I can make money. I have to build it up again, but that's better than having a mark of all of this loss and people aren't going to get in anyway. So there are different tricks of the trades and different insights that I take when I examine a PAM account, but I like to see that it's with a good broker. I like to see that people aren't going in with crazy funds, because I think that could be a little sketchy. I like to see that the deposits and the withdrawals are disclosed. I like to see a bunch of people get in. I don't like to see like 1 or 2 like big whales get in, because that could indicate that there's something fugazi going on. And then sometimes I like to see losses. I want to see, you know, how they handle a drawdown, how they handle a loss. Are they psychologically able to do it? And those are things that I look at. And then of course, the most important thing is, you know, is it going to overexpose me if I get into this thing? You know, I'll get into anything for $100. I mean, basically.
I think to the extent that you're describing with it's basically due diligence. I don't feel like most people do that. I don't even know if I did that. Like, I haven't been in a PAM account for a little while, but I don't even remember going to it through that extent. So essentially, guys, I mean, like, losses can be a good indicator. If you see something that's never had a loss, probably a red flag. Even the best traders that I know personally that are, you know, trading on Forex, they have losses, but they have stop losses as well, right? I mean, like, it's part of the game. And it's part of the psychology, to be honest with you. So I think a lot of people are not doing that, and I think you really broke that out really, really, really well. Cory, did I understand, because you mentioned basically kind of fudging of some numbers. Is that specific because the PAM account and the broker were owned by the same person? Is that how they were able to do that, or is that something that's a little bit more common?
The biggest example of that is Trader's Domain. I don't know if you heard of them, but CoffeeZilla just did like a whole big thing on them, and I know some traders that were involved with them. So basically, and this guy is really sharp because he's not in jail yet, but basically he was making trades, and then they were actually going back in time because they were disclosing them in real time and changing the actual chart numbers to make these things profitable, which is it's utter nonsense. There are different types of brokers out there. There's A book and B book, and B book, basically they get to make up their own numbers, and basically they could use their own proprietary charts And most brokers are B-book, even the regulated ones in the United States, and they won't offload your trades into the open market until they flag your account as profitable, because they're going to make money off of all your losses, and they'll make even more money. Basically, they're B-booking to the extent of they're making up their chart numbers to comport with the trades to make them look profitable that they've taken. So yeah, if there is it's quite easy to take. Fixed Master Gold did was they took a platform of a broker, and then they took this copier, and they merged them together. But behind the scenes, they were all in cahoots. And the biggest red flag from that was they were both created at the same time. So if you look at a broker that's been around since 2016, 17, that's ancient in DeFi, right? They're not looking to make money off of a scam. They're not looking for some trader to come up, put $1 million in there, invest in a PAMM account, or 10 million or 20 million, because it doesn't mean anything to them. They're going to lose their entire business that way. So I definitely is a red flag. It's a huge red flag when a broker and the trader come on at the same time. And that's quite easy to verify these days. That's a big red flag.
We got a couple questions online. Kurt was asking about NVFX, what your opinion is on that broker. I've used them. I think I actually still have a live account with them, but don't know a lot about them. And what would your opinion on those guys be if you're comfortable sharing that?
Yeah, NVFX, very popular in the PAM world. I've used them. The function of their broker is very good. They don't mess around with the charts. They say they're A-booking. I don't buy it. That's not here nor there, because you can make money with a B-book broker just fine. And they have other sub-brokers under them. FX Sway, I think, is one. I think they got another one. The problem I have with NVFX is their customer service, honestly. I don't have a problem with getting money. I don't have a problem with their charts. I don't have a problem with how their system works. But I went through an entire process of getting my corporation registered with NVFX, and it still had my name in there when I would refer people, and it became a real shit show. So I have a big problem with their customer service. If NVFX was the only broker I could tell a trader to bring a PAM account to, I'd feel relatively safe and understand the customer service is going to be extremely lacking. But I think there are better options with phenomenal brokers out there with phenomenal customer service, and also offer the stability in terms of the technicalities of the trading and the on and off the crypto, the whole thing, that are better than NVFX. But if you're with NVFX, I wouldn't be worried in terms of like an institutional problem with them. They seem pretty solid to me. But again, the customer service with them is severely lacking.
I agree. I mean, we had a couple of people in our community that were doing very well in a PAM account. I mean, they had hundreds of thousands of dollars. I don't recommend that, but it was their discretionary income. These are high W-2 earners, that are doctors and lawyers, etc. But just some of the horror stories, and never happened to me, so not personal experience, but they just, hey, we need to make sure you're not laundering money, and we need you to provide all of these documents or all of this stuff. So some of that was weird, but it did get resolved, and this person was able to pull out his funds without any problems. Another question, going back to the PAM accounts So how often do you look at the trades in these PAM accounts? How much monitoring do you do? Is it mainly right in the beginning, when you're deciding if you're going to be using them, or weekly, monthly? What does that look like?
So I review it weekly, personally, and I do a weekly report, and I go over basically the performance of the PAM. The exception to that is when something bad happens. When that happens, my phone blows up, my DMs blow up. Whenever something bad happens, I feel everyone comes out of the woodwork, and then I try to analyze it and say it's time to bail, or it's a blip in the road, or we'll see, we take money off, or maybe it's an opportunity to put money in, because again, if you have a track record with a great PAM, he takes a loss, and maybe that loss won't be made up for the next 4 weeks. Well, guess what? Those 4 weeks you're making without the profit rate, because the PAM manager can't take his money out until that PAM is back in the profits. So while that fee, which can be significant, is taken out, maybe sometimes as high as 40-50%, I'll put more money in and I'll make my money back faster because I've already seen the track record. So it's dependent on the situation. My situation is in terms of free risk capital and how I want to allocate that. Sometimes I'll just swing it around a little bit.
A take profit strategy on the PAM account specifically, do you mean when it hits a certain percentage goal and you cash out and move on, or is it something different?
There are many ways to approach it. Some people approach it taking out every week, which I think is, for a beginner, is really good. Just take out your profits every week. You can't go broke taking profits. I think for a beginner, that's a super great idea. And I know a lot of my community do that. Another way to do it is to get to a certain percentage level of gain and then take it out at that point. Another way people do it is they just keep compounding until they double their money, and then they take out their initial, and then they'll spread it around again, which is the riskiest way to do it.
100%. My call last week, what we realized, or what we determined, was trading, like the trading bots require a lot more management, a lot more monitoring. They're a lot more time intensive than people think. So myself included, I was like, oh, it's a bot. You set it, forget it, push XYZ, does its thing. Wanted to make more money, you just click another button. Really not the case. We learned that last week through an interview. And what I'm realizing, just at least through our conversation right now, is the PAM accounts, it's more of a game than I thought.
Yeah.
So a lot of times, like people.
I was just saying, I can give you a quick story. There was a PAM account that I was promoting heavily on my channel with a Docs trader. He was in Tampa, a few hours from me. His name was John Neeson. He was actually an actor. Okay. And he turned to be a trader, and he had this data trader account. I started promoting it on the channel, and the TVL got up to over $1 million really fast because this guy was making crazy money. It was a gold bot. Okay. The one thing that he had to do was every NFP, which is the first Friday of every month when non-farm payroll comes out, is turn the bot off. Okay. It's all you had to do. Is turn the bot off. Okay. This one guy, beautiful man. I had a great conversation with him. He had him on the channel a bunch of times. He's running this bot. NFP comes out, right? I didn't even think about it because I don't even trade during NFP. I don't mess around with red folder days. I'm in the drive-through at McDonald's in the morning. I want to get my Egg McMuffin after I drop my kid off at pre-K. My phone blows up. He didn't turn the bot off. He didn't turn the bot off. Jobs report came out, went to shit. Gold tanked. He was in all buys, and it was a DCA strategy. He bought all the way down, and that was a Friday. That Monday, the entire account was liquidated, and the whole thing he lost $1 million. And it was like 10% left of what everybody invested. I think it was like 100. I don't think there was like 70 something grand left in the account from over $1 million. Crazy loss. And all he had to do was shut the freaking bot off, and it wouldn't have happened. And people don't understand that. They were like, it was a collusion because it was LQDFX, which is a freaking great broker, been around forever. It was a collusion between LQD and John and this and that. And I'm like, you could see it in real time that the numbers were in there. If he knew that these NFP numbers were going to come out that way, we could have all retired off of the move he could have made. It would just bought the other way. And people don't understand that because they're so used to these rug pulls that they don't understand that it's genuine trading and that there are losses. And people make mistakes. And this guy, who was a great guy, and I had him on the channel a bunch of times, literally forgot to turn the bot off, and over $1 million was lost. So that's the lesson. It's like, it is really risk capital. Like people think that I'm saying it tongue in cheek. Oh yeah, it's risk capital. Go ahead and put all your money. I'm not saying that. I'm saying you could be consistent and slow and methodical to turn that small risk capital into larger risk capital. And once you get to that larger risk capital, you can start making real money on it, and you can start earning an income on it, and you can start relying on it as long as you're well diversified. And people don't understand that. And you can't start out that way, because if you say, I'm just going to skip that step and I'm not going to start out small, I'm just going to, I just want to be passive right now. I'm going to put all this money in and I'm going to make all this money, but you don't have the experience to know what to do. And I can't tell you, and no one else could tell you or generate that experience for you. You could only do it by learning, by taking those losses, by making that money, by understanding where the risks lie and understanding not to over leverage. And these are things that people hear me say and they think they understand, but until you live through it, I don't think you do.
I think the mindset is, well, that's why I would do a PAM account, because I don't want to learn. I don't want to ensure, understand its folders and turning this on and that. Like, I don't want to do that because I don't have enough time. Maybe they work a W-2, maybe they have kids, like whatever it might be. And they think that either crypto or PAM accounts are passive. No, not really. Just like, so like my background is real estate. We got multi-million-dollar portfolios. We've been doing this for a long time. Real estate isn't passive. No, it's not passive. Maybe if you're buying a note and you become the bank, maybe it becomes a little bit more passive, but this is an active business. Like, I actively manage the business. I actively manage the people and the projects and the P&Ls and the quarterly reports, all of that. So I highly suggest for anybody that ends up watching this replay, really take to heart what Cory is talking about with due diligence and management and monitoring. I think probably most of the money that I have lost has been because it was actually on my end. It wasn't on their end. Sure, they messed up, but it comes down to me. It comes down to my decisions. So guys, remember, you are the asset, right? It's not necessarily a PAM. It's not a bot. It's not Bitcoin. You're the asset. You make the decisions. You're the human being that has to regulate your emotions and your decisions and really, really look at risk capital and playing the game. Like, going fast does not get you further. A couple more questions. And where I was going before that was, I'm realizing that it is more of a game with the PAM accounts. It's not just set it, forget it. When I did this a year ago, I thought it was, but so we've learned a lot about bots in the last couple of weeks. We've learned a lot about PAM accounts. For people that want to get a little bit more serious about this and want to consider joining your community, what does it look like? Where can they get more information on that?
Yeah, traderslanding.net. And if you go to cryptolanding.net, actually, you could join for free and post basically stories and commentary, and then my analysis of different, I do a market scan every week, actually twice a week, of all the instruments that I trade, 28 instruments. And then I discuss all the passive trading income, and then whatever anybody wants to talk about, I'll talk about basically.
Cory, it's been a great conversation, man. I've learned a lot, and I do this full time, man. So greatly appreciate your time.
Sure.
We might try to twist your arm and have you come speak in October if you're around, but
Okay.
I'll talk to you about that offline. But you are a wealth of information and knowledge, man, and I think you're doing great things for the community, for the industry in general, man. We need more people thinking and talking and expressing like you have today. That makes the community stronger in general. So,
Awesome.
Cory, I greatly
Sure.
appreciate your time.
Awesome, man. Thanks a lot. Appreciate it.
Guys, make sure you say thank you to Cory. I believe he is in our community, so you can just drop a comment in the Alternative Investment Mastermind, thanking Cory for his time. Cory, again, greatly appreciate it, and talk to you guys soon.
Thanks, Jordan. Have a good one.
I literally don't know how to stop this. I have to walk over there and turn this off. But thanks again, Cory. I appreciate it, man.